Hi, I'm Christian Milau here, CEO of Equinox Gold, and we're probably the fastest growing intermediate gold company out there. And we have 7 producing mines and 4 growth projects, and moving our way towards 1 million ounces of gold production in the next couple of years. So exciting times, and maybe turn it over to you for questions.
Christian, good to have you back on. I've seen you for about 18 months. You've been busy building a company, as you say. But share price, where's it all gone wrong?
Yeah, it's been definitely a tough, I'm going to say a year or so, maybe a little over a year. And, you can blame a little bit on the general markets and the sort of lack of interest in gold, but we've had one specific issue for sure that we've been dealing with. And ever since we acquired Leagold, which happened, I guess it was closed on March 12th, I think it was, in 2020. Since then, we've really struggled with Los Filos in Mexico. And that mine is really not had one full operational quarter, I think, uninterrupted. We had COVID hit it, and it was down for Q2 last year. And then we had a blockade after that. And then we had another kind of blockade and a half this year as well. So it just sort of seems to have gone terribly difficultly. Hopefully we resolve that. And we've definitely stepped in, and we did change some of the senior management to an experienced Spanish speaker who's worked only in Mexico pretty much their whole career versus what we had in there that probably was a little less experienced in that area. And since then, we've been kind of building that relationship back up, but we've had to take a fairly hard stance and view on a couple of these issues around the blockades. And, we just can't accept that kind of behavior as the ways to resolve, call it disputes or issues. And they really stem from, call it 2 communities, particularly wanting more of the economics of the new areas that we're investing in, the 2 new ore deposits. And so we're willing to share jobs and contracts and things like that, but we can't do that to the detriment of other communities and other workforce members. And so in a way, that's been the crux of trying to stabilize the relationship, get sort of an understanding of that there's 3 communities here, not just one in each of these areas. And, I'm happy to dive into more detail on that, but we've come to resolution, I think, with these groups, I hope, and we don't go back there, but it'll take time to rebuild that trust, and it won't happen over a quarter or 2.
Okay, yeah, I wouldn't mind a bit more detail, but in a minute, I want to start at the top and work the way down. So it's been a tough year. You can blame the markets. Filo is a contributing factor, but your costs are still high. When are you going to be able to reduce those costs? Because obviously, I think people saw you did well when gold was shooting up towards 2,000. Gold at 1,700, we're still not bad, but compared to the your average ASIC number here, people are looking and going, well, actually, this is a bit close. Something else goes wrong. These guys aren't making as much money. I'm a little bit nervous. Is that too simplistic a way to look at this?
Well, no, it's correct in terms of the actual numbers right now, but we really are investing in our assets to get them to that cost-based level that really improves them. And we sort of said pretty clearly the first half of this year was really about investing in particularly RDM and Mesquite through, call it major pushbacks, which had, call it less ore and lower grades, et cetera, going up to the leach pad or through the mill. And in the second half of this year, we're starting to see certainly Mesquite turning that corner as we've invested, almost $50 million in some stripping there. And RDM has a almost 2-year program of stripping that it's still producing actually decent cash flow, but it's a 2-year period of getting that ore deposit opened up. And then Filos has been overhanging that from a higher level that, with the inconsistent production of a big leaching operation, the costs have been high. And it's going to take us some time to turn that around. In the long term, we want to put a CIL plant in there that'll bring that cost down. But part of the overall strategy here was kind of some base hits, some assets that maybe needed some work or some development or rebuilding. And as you improve those, do some exploration, as well as build out these growth projects, your average cost comes down over time. So it's an investment phase that we're in, and, we'll be improving gradually here. But the big hits are when you get Santa Luz in production beginning of next year, you get Greenstone in production in 2024. You've got a couple other mines beyond that as well that'll have improved costs. So it's a gradual process here.
But you've moved from an M&A team into one that needs to be an operator. I mean, an efficient operator, one that can show the market that you're going to be able to execute your plan, right? So you want to be 1 million ounce a year producer. That's the goal. That's what you said to the marketplace, okay? So you need to show that you can do that without the hiccups, with the reducing costs, with the increase in production. You're around whatever 600,000 ounces at the moment, so you're well on your way there. have you got the team to do that? Have you lost the M&A mindset and moved into operational mindset? And have you had to acquire people to allow you to do that?
Yeah, I'd say it's been evolving. And this year we've purposely, since Doug Reddy's taken over as COO, he's been building out his skill set and team here in Vancouver. And we brought in some people's experience in operations on the ground, building bigger projects, technical skills that maybe we didn't have to the depth that we needed here in Vancouver. And so that's now sitting there in a team that's ready to support, oversee, and really be the oversight of these big projects and the growth and M&A or integration of that M&A. Where in the past, you're right, it was a little bit more lean, nimble, entrepreneurial, and I'd say we're building that out without trying to be too big in corporate. You know, we still want to keep a bit of a creative entrepreneurial edge to us, and that's Ross Beaty's MO really historically.
Yeah, but there's kind of crossover point where the entrepreneurial spirit is to the detriment of the consistency to the planning, etc. Do you know what I mean? You've got to get the balance right, because in a very meaningful way, I don't care what your projects are. I care that you get to this 1 million ounce number that you're telling me about, and I care that you can do that efficiently and making money consistently, and you're doing that sort of risk mitigation across the board in every single way that needs to happen. Do you know what I mean? So you people start looking at you differently when you're 2 billion or previously bigger than that $4 billion company. I stop worrying about the kind of detail. I'm worried about the delivery, the bottom line. So have you changed that mentality internally as well?
Yeah, absolutely. It's more of a portfolio effect now that we've got to manage the overall portfolio and deliver. We do have to deliver on a quarterly basis, but we still have got our view out there for the next few years. And as you said, we want to get to that 1 million ounces of production by, call it run rate, sometime in 2024. And that's when you become more of that cash flow machine that ultimately is going to be paying a dividend to shareholders. And so we don't want to lose sight of that longer term objective. And we still have to deliver on the quarterly results, but we don't want to do anything to the detriment of that long-term objective. And, we've really set that pattern, that ambitious growth goal. And, growth at the moment in this sector, yeah, it's probably not overly loved because I think people are looking for cash flow and consistency and a dividend being paid, but that will come back in due course. And very few companies of a scale of ours, sort of mid-tier and above, have much growth. And I think you will see some M&A, you'll see some investment in these smaller assets. And, we've got that in our portfolio now and it's fully funded. So I think it's a really interesting environment to be looking at a company like ours. And, from a purely personal perspective, myself, Ross, and the whole management team were buying stock in August. We were like, wow, you get to buy this stock at less than $8 a share. We're a bit above that right now, but we were going, what an incredible opportunity in kind of a decent gold market, but a terrible sentiment market for the equities. And so it was a really interesting time this summer.
Well, yeah, I guess that's a line that most CEOs will throw at it now. Our stock is cheap. What a buying opportunity. But the reality is that people are perceiving the sum of the parts not as valuable as you would want them to be, as they possibly have in the past. I mean, what's the one thing you'd actually put that down to? It's not just the market and gold price coming off. Is it? Do you think that they've lost faith in the management team to deliver this consistency in terms of the ounces, or the fact that it's this slight immaturity in the way that you're approaching your communications with the market? I mean, what's been thrown at you? You're at Beaver Creek. You're at Denver. What was being thrown at you there?
I think the two major things, and we've already touched on the one, is resolving Filos in a longer term manner that ideally doesn't see that come back again. So that's one thing we need to get behind us. And the other one is really about execution. That's been the big question. Can you execute on these big projects? Can you keep them going sequentially? Can you fund them and turn these into good cash flow machines, essentially? And in a sense, it may be a wait and see for some investors, and we'll have to just prove it. But when you look at the last 3 years, when I include this year, we'll have built a mine per year, taking mines that had historical challenges, recapitalizing them, getting them up and running. And, I think we've done a pretty good job of that. And Santa Luz will be the next one, which will be done around this year end. And then Greenstone will be the big one that we'd like to announce, in Q4, certainly late this year, that we're in full construction and set a really good timeline and that CapEx number and then deliver on it. And it's a big Canadian project that I think will be a cornerstone to our success as a management team and a board in terms of delivery and execution.
Are you seeing more? This more market commentary from you. Are you seeing as now a producer of significant producer? Are you seeing the local communities taking the opportunity to ask for more and get more from mining companies? Because we're seeing lots of issues. You've had blockade issues. We've seen that across multiple jurisdictions. Do you think the ESG narrative is helping their cause? Is it something that you mind? Do you think it's something that they are entitled to? Do you think mining needs to up its game? I mean, how are you as an organization viewing and tackling that? And in fact, who's tackling that internally?
Yeah, I mean, ESG has become such a prominent, important factor in everything we do. And I think a lot of mining companies do a much better job than maybe they're perceived to, because it is a cornerstone part of what we do. I mean, we're in local communities. You need to employ and give contracts and, actually give back into those communities. And it should just be sort of like health and safety. It should be something you do on an everyday basis. And one of the things I think we've been poor at as a mining group, generally as a sector, but maybe even with us as a new company, is really communicating it. So getting your forms of communication, your tools up to speed, building out that team. And that's actually been the number one growth area, other than the pure technical skills in Vancouver, is ESG. And your cost of capital will go up if you don't get better. So we're going to be looking at that whole carbon emissions, net zero, all that side of it. But I think the real crux and basics are, what are we doing on the ground? And, we've had a couple of good examples over the last year, and Los Feliz being one, where I do think the communities are looking for more generally. Certain ones are definitely more active. They're learning how to harness social media and to work with NGOs and that, probably to get more, call it leverage than they normally had historically. And social media is a double-edged sword. It can be good for us. It can be difficult for us as well. And an interesting example was at Arizona. We had historic floods in the first part of the year, and social media and a couple of NGOs were reporting them as tailings dam failures. And so for us, it was just a terrible social media issue that we had to deal with. There was absolutely nothing wrong with our tailings dams, and all our infrastructure was in good shape. But that misinformation, you have to counter it and deal with it. And in social media, it's a world that once it gets away from you, it can be hard to control in that environment. And so I think we're also learning how to deal with that. And it can make a small group of people very, call it, powerful in terms of their voice. And so I think us as a company have to get ahead of it in terms of all those good things we are doing in these communities, communicating them more regularly, making them available to investors, but also to those communities and to governments as well. And governments are taking a very strong interest, because a lot of voters are now voting with an ESG hat on as well, or certainly a green angled hat for sure.
Well, yeah, if you look at the German elections, they took a significant slice of the pie there. Yeah, it's an interesting one. There's a two-edged sword of social media. It can be your friend and your ally, but in equal measure.
Yeah.
If you don't have a response to some of the things which are out, misinformation, I think it can be problematic for you guys. So just sort of coming back to the numbers, you're sitting on talk us through how much cash are you sitting on?
Yeah, we're probably about 330 million of cash right now. We've got a couple $100 million available in our revolving credit facility. We're sitting on $400 to $500 million of investments in Solaris and I-80, generating decent cash flow. And so we've got a pretty good balance sheet at this point in time. And interestingly, when you look at our banking group, when we originally built this company kind of around the time of the Leagold acquisition, the company's probably almost doubled in size in terms of scale and asset base, but we haven't actually changed our financing structure. So part of what we need to think about in 2022 is just maturing our capital structure. Maybe not having as much reliance on a, call it, shorter term floating rate revolver, and maybe we put a bond in place that just extends the duration and maybe fix that coupon in a pretty low historic interest rate environment.
Right. That would be interesting, just to understand how you do tidy that up, what you do use that cash for. Obviously, I don't think you're going to cash in any of the equities that you've got at the moment. Well, are you? You wouldn't make sense. The companies wouldn't be happy.
The way we think of it, with Solaris, we spun that out 2 years ago. It probably had a 50 million market cap. It's now $1.5 billion Canadian, whatever that number is. I haven't looked recently. But they've had a fantastic run, and they're showing that they've got potentially a world-class porphyry there in Ecuador. And, we've said, and I think Ross has publicly said in some of our webcasts, probably within 12 to 18, maybe 24 months, likely that'll have so much interest from the major copper producers around the world that need scale and growth that it'll get taken out at some point. I mean, there's no guarantees, but that's a possibility. So we see ourselves with Richard Wark owning 40-50% of that stock, and we're just under 20, and I think he's in the mid 20s, if not the high 20s, and we can ultimately deliver that like he's done with most of his big copper projects in the past. I-80 is a little different story. We own about $150 million stake in that US. When we spun it out and Ewan went off to run it after buying Premier Gold, we bought Premier for, I think it was almost $500 million US in terms of market cap. I-80 now has a market cap very similar to that, not quite, but very similar. And we own 30% of it. And that's a Nevada-based, he's just done an asset swap with Barrick, but essentially a Nevada-based growth-oriented gold company. So strategically, that one is more interesting long-term where, it's just in our backyard. We're just across the Nevada border in California with our operations. So, if he can turn that into a 300,000 to 400,000 ounce plus producer in due course, and there's some work to be done there, us owning 30% isn't a bad place to be.
No, we've had you on. We also particularly like Solaris. I think it's a great. So I think it's still got a lot of growth in it as well.
Sure.
So let's come back to your growth component. So with the cash that you've got, we can clean up balance sheets and so forth and move things around on the spreadsheet. But with regards to the cash you've got, how do you allocate that? Is it all about trying to optimize the projects that you've got now in terms of efficiencies, in terms of actual ounces coming out of the ground? Is all that money going back into the projects, or is there a possibility of a dividend anytime soon?
Yeah, I'm going to say not quite yet. It's more likely once Greenstone's up and running. A lot of our capital will go toward, finishing off Santa Luz. That's a small project that'll be done this year. So most of it will go into focusing on Greenstone over the next two and a bit years. And so I don't think you're going to see us paying a dividend until that's got clarity and a finish line in sight. And we're generating the cash flow from that, because that's going to be a massive Canadian mine that'll be third or fourth largest in Canada. And so we'd like to see our dollars put into the ground there. We think the return is better by doing that. And then eventually, once that's done, there'll be excess cash flow to start returning to shareholders. Okay,
fantastic. And with regards to the kind of extending life of mine with Fazenda, Mesquite, Arizona, I mean, what are we talking about? You're not going to double life of mine here, are you? What's your ambition with those? And how do you fill those up when they start running out? I mean, what the kind of growth profile is what I'm interested in.
Yeah, and you hit the right ones there. We will spend most of our exploration dollars around the mines that have less than a 10-year mine life. So Mesquite, we just added almost 750,000 ounces to resource. Just recently, we put our results out this year. We're still drilling away there, so we see conversion to reserves and ultimately adding resource. That one, you're probably not going to see a big bang doubling of the mine life. You'll add a year or two every year or two. And maybe in the longer term, you can kind of double mine life when you go across the highway. So that one's kind of more of a work in progress. Every year you add a bit. Arizona, we just put out a study a few weeks ago that almost doubled the mine life, and it comes from underground and a bit of the open pit. And we see more open pit deposits potentially along strike there, and definitely more coming from the underground as we drill. So that one you'll see us put dollars into and continue to advance that. And we've done the big bang, sort of almost doubling the mine life this year. Now I think it'll be a bit more incremental, and it's an 11-year mine life as we speak. And then the other one, Fazenda, we think of Fazenda and Santa Luz as almost one complex. Santa Luz has a 10-year mine life when it gets up and running at the end of this year. Fazenda is probably 5 or 6 right now, but it's one of those old sort of school underground mines where you kind of drill just a bit ahead of you add a year or two here and there. You never kind of add 5 or 10 years unless you get into one solid area that you're going to be able to massively expand. But I think what you'll see there is that complex. We've grabbed a bunch of exploration ground between the two of them. We're drilling them right now. There should be drill results out publicly in the next month or two. And what I think it'll show is that there's a 70-kilometer greenstone belt between the two of them. We've grabbed a bunch of exploration concessions that were put up for auction this year, and you'll see that whole complex grow. And we see it like Arizona. We've got 2 core districts in Brazil that have potential to grow and be sort of multi-mine districts. And we'll keep investing in that as well.
So I'm kind of really intrigued by the kind of the hit team that you're putting together in Vancouver to be able to help the different operational teams to do the optimization, because to go from 625 up to $1 million, that's significant, right? You know,
Yep.
I get greenstones coming in, and you know, and hopefully Los Filos, you know, comes back on at some point. But you're going to have to do some real heavy work on the current assets to kind of, you know, move up to that $1 million mark. So, what sort of timeline are we looking at? How confident are you, though, that the efficiencies will come, i.e. this ASIC number will come down? Because there's a sort of mental block, I think, with certainly with retail or family offices. They're like, if it's above $1,000, it's probably not attractive. People are attracted if it gets below that kind of magic number. And I know that's not necessarily the real world, but that's just perception as reality, right? So how are you going to allocate this sort of hit squad that you're building up from Vancouver to the various companies, and, you know, what are you targeting them all with?
So basically, each of our projects will have a dedicated project team because they're also in very different regions and cultures and that. So Brazil has its own, which a lot of them are involved with Arizona build 2 years ago. You know, Ontario, we've got a group of team that's building up a structure that has ex-Agnico team that helped build some of the Northern Canadian mines. And so those will be very discrete, and they'll focus on that. There'll be oversight from Vancouver looking at project controls, capital allocation, cash flow, how they're financed, the technical aspects and challenges that will sort of kind of assist in these processes and review them and give oversight. And we'll focus on getting Santa Luz done this year. And as that's coming to a finish line, which it's getting pretty close to right now, the attention goes to Greenstone. And that'll be a 2-year process. And really, you'll be looking at, call it 700,000 or 800,000 ounces of production next year with Santa Luz coming online. And then you've got that next step change will happen in 2024 as you get Greenstone into production. And with each of these coming in, you have reduced costs because these are more efficient, longer life, you know, higher quality mines. And along the way, we may sell 1 or 2 mines as well.
Well,
and that may help.
That's what I want to ask you about, because, like, you know, because is that part of the responsibility and the remit of the sorry, I'm calling them a hit squad, but you know what I mean? The head office team are looking at it and saying, example, Mercedes mine, come on, it's 35 ounces. That doesn't touch the sides. We need more from you. Either do that or we sell you. I mean, do you know, you're going to have those sorts of conversations on a monthly or quarterly basis about what's the right thing to do here, because you could sell, you could also equally buy. So are you constantly evolving that discussion, that conversation on a monthly or quarterly basis?
Absolutely. And you're bang on. You know, the 2 smallest mines will always be kind of in the sights to be discussed. So both Mercedes, which is probably 40 to 50,000 ounce producer at the moment, has potential to go to 60, 70, 80. And then you've got RDM, which is 65,000 ounces at the moment. And, you know, they're looking at a plan to maybe go to 80 to 100. So if they can achieve these kinds of levels, it becomes more interesting. But I do think if someone's willing to pay a reasonable price now, in terms of multiples of cash flow or something, it might be interesting to us, because that attention we'd spend on, call it even doubling the size of those small mines, pales in comparison to looking at Greenstone, where you're looking at hundreds of thousands of ounces, or expanding Filos or getting Santa Luz on stream. So I think you could see at least one of those end up being sold. We did sell Pilar, obviously, earlier this year, which was even smaller. And I think it shows discipline. And we had some shareholders saying, focus on a discrete, decent number of assets with some scalability to them, rather than actually spend your time at the lower end of your portfolio. And, you know, it's a natural evolution we've seen in some of the bigger companies. I was at Endeavor Mining before, and as I was leaving, we were selling the small mines, and focusing on the bigger ones, and look where they are today. And in a sense, that we're at an earlier stage of doing that kind of process and analysis, as you said.
That's when we're talking efficiency, it's not just literally at the operational level. It's through, you know, corporate as well, because you know, 100,000 ounce a year producer for another company, single asset, around being valued around 500 million market cap.
Yeah,
that just seems to be the norm for you. It's almost like you're getting a discount to that because of everything else and all the other moving parts, and perhaps it's a too big a story. And these are the trials and tribulations of billion-dollar companies. The growth story gets harder to tell. The ability to focus enough time on all of the moving parts becomes more complicated, and you have a whole different set of challenges within your organization. And I think, you know, I wonder if you're suffering from a little bit of that. It's not, you know, like I say, it's not just necessarily Los Beaty in the market, etc. Is a little bit of that. People going, this needs a lot more focus from you guys.
I think it's absolutely right. I think we've heard that directly from some of the investors. Please sell one or two of the small assets. Another option too is we've got a few exploration properties in Red Lake and parts of Ontario. And right now, I bet you don't even know we own them. And so maybe we spin them out like we did Solaris, because actually most people didn't know we owned those. And look at it now. And that's another way to call it surface value, at least. So I agree. We got to keep with the discipline at the smaller end of our portfolio, keep our attention focused on delivering and executing at the bigger end. And, historically, if you look at some of the multiples paid in our sector for, mid-sized companies, if you have more than, I don't know if it's 35% of your portfolio in development assets, sometimes you get that reduction in your overall multiple because it's got risk, it's got development risk to it. And so part of our job here is to continue to bring these ones in, execute on them, and make a bigger proportion of our portfolio producing, and obviously consistently producing at a good cost. And the other battle that's coming up today too, and something that we haven't touched on yet, but inflation is out there, and that's something to keep an eye on. And we're certainly building some projects, and we're seeing some of our ongoing operations start to talk about fuel. Obviously, fuel prices are going up at the moment, but some of the reagents, maybe some labor and that. So it's another area to keep an eye on, I think, as we move forward into 2022 as well. And is it transitory? Is it permanent? How do you manage it? How do you get discounts? We're going to go to joint purchasing initiatives across our portfolios. And so there's lots of work to be done there as well.
Yeah, I think those are conversations that people have wanted to have, or excuses that they've wanted to discuss, over the past 3-4 months. But, I think you're all in the same boat, right? All your costs are going up equally. It's labor is hard to get a hold of. COVID has impacted costs, transportation, fuel, everything's gone up for you guys. It's a tough environment for sure. But, you've got to be as efficient as you can be, given that, just like everyone else has been. So I've been fascinated to, hear from you the things that you are looking at, the moves that you could make, and you've got the options to be able to make. You've got a lot of cash available to you too. So now, look, I've enjoyed that. Look, I've really enjoyed the update, Christian. I mean, like I said, you're busy, being very busy, and I think you want to now show the market you've moved from pure M&A through to an operationally successful company, but you haven't necessarily entirely lost the entrepreneurial and M&A thought process in there to keep your options alive. No, it's been a good session. Thank you.
It's a fine balance, and it's hard work.
Yeah, I bet. Who would want to be a CEO of a mining company, Christian?
It's a heck of a lot of fun too, though, I have to admit.
Okay. Well, I appreciate your time. Stay in touch. See you soon.
Thanks, man. Thank you.